this morning. Okay. Getting a bounce back in the markets here today. Not surprised. Uh, I told my black team this morning that if we didn't see another plunge downward, we're probably going to have a big update today because um, the longer that there's no additional plunge, the greater the confidence in going in after a 10% correction here. Nasdaq's had a 10% correction. Guys, just so you know, the thresholds that are commonly accepted, there are thresholds that are commonly accepted in the professional world. Like 20% is pretty, beyond 20%, you're pretty much in a, you're entering into a bear market. A 10% is a correction. Right? So when you have an overall average drop 10%, it's corrected. All right. Nothing before 10% is considered a correction. Okay. 20% starts to mark bear market, and 30% you're in the middle of the bear market. Like that is in the heart. There is no zero question. It's just the bearish, the heaviest level of bearishness you can be. So those are the levels 10, 20, 30%. All right. So with the NASDAQ having dropped 10% in a few days, it was officially yesterday a correction in the NASDAQ. All right. Those thresholds do tend to bring buying in. All right. Because they're so prevalently known. And so 10% news starts reporting correction. NASDAQ is officially corrected. Fresh new buyers come in, especially money that's been waiting on the sidelines. It feels like this run up, when is it going to be over? I want to buy on a pullback. And so when there's a lot of news about the pullback is officially a correction, it brings in money off the sidelines. So that's what we're really experiencing or seeing today. All right. The question always, remember, when you have this strong drop to the downside, right? So this is the 10% drop, right? The question always, and this is what I teach you, is what tells you everything is on the move up is the real answer. You understand? That's the real answer. What does the market do? How does the market react on this move up against that? Now, we've been in the market environment where this has just wiped out that with greater ease than normal. Okay. So we're going to see if this 10% drop is going to, with relative ease, take out. If this move up is going to take out this 10% drop in the NASDAQ. Well, that's the number one key right now. Watching this rally. Okay. Make sense? Which trade are you in, Tal? Okay. And where did you get in? You stuck. You can't exit. A quick scalp doing what though? Where did you get in? Talk to me. You shorted the tail up here, but but you said you were in it 10 minutes ago. So there was no tail 10 minutes ago. You mean this one? That one? That's about 10 minutes ago. Which tail did you short? 10:30? Oh, this one. Oh no. Well, how is that? You said you were in it 10 minutes. So you were profitable in the play, but you couldn't take your quick couldn't take your quick profits. Guys, let me just come out of this play here. I'm short here on the Facebook. Whoa, that's weird. Stupid. Give me a second here, guys. I'm gonna try to. All right, guys, I shorted this right there. Let me give myself a little quick little thing, but now I covered and went long. Let's see if that works. I'm okay. It comes down in that area. Let's see. All right. Um, for small loss, did you have a gain towel in it? You had some pennies in it. Yeah, it's frozen. Which symbols are they having trouble with the S symbol? Guys, I know it sucks, man. We just have to bear with it just a few more days here. Just a few more days. All right. Oh, that's crazy. I don't get that. All right, guys, I will ignore you if I don't sell this. So nice, nice. Went short, cover went long. All right. Um, today's our day. We begin. Are you guys ready? I don't want you distracted here. So, you guys ready? Ready to do this thing? Ready to start from scratch like your babies? All right, let's do it. Let's put together a master list. Let's let's build your personal trader, okay? That's what we're going to do. This list is going to be your personal trader. This list is going to trade for you. Guys, give me a second. Hey, what's up? Huh? Sorry about that. All right, guys, sorry about that. All right. Okay. Guys, when I say wait a minute, that means that there's going to be no sound, okay? Um, so I'm going to do a lot of this on the whiteboard, traders, but what I want you to do is each section, I want you to take a picture. I'll tell you when. I want you to take a snapshot or an image of some sort, and I want you to save it individually. Because what I really want you to do after we put this together, I want you guys to build your own. I want you to make it as nice as you think you can make it. And if you like, I'd like you to send it to me, whether it's in spreadsheet form or beautiful image with colors or whatever. If you don't have to, but I'd like you to send it to me. And I'd actually like to select one of them to display if you're okay with that to all of our mentorship traders. But I'm going to start off by telling you that there are 7 parts of a trade. That's it. Only 7 components of a trade. Now, there are many traders, guys, who don't even know this. They just think trading is buying and selling. But there are 7 components. And out of the 7 components, the most important components are not necessarily the buy and sell. You understand? So we if there are only 7 components, we have to make sure that we are doing the right thing in each one of the 7 parts. And that is the magic key to proper trading. Understanding the 7 parts and making sure during every trade that you are handling each one of the 7 parts properly. And that's what building this master list is going to be all about. You understand? Defining what those 7 parts are and running every trade through each one of the 7 parts and making sure that you handle each one of those 7 parts properly. Okay? Now, this is going to be put together in the form of a master checklist. So we're gonna checklist our way through each one of the 7 parts the same way we say, look, I need seven things from the supermarket today. You build a list, you write those 7 things down. And so maybe one of those things is milk. Boom, checklist, got the milk. Bread, boom, checklist, got the bread. That's part 2. Part 3, salad, boom, checklist. And after you check off all 7 parts, your shopping list is over. That's what we're trying to build here with our master trade list. That if we have a list set up before each trade, and if we check off the right component in each one of the 7 parts of a trade, we get the 7 check marks correct, we should have money the vast majority of time after the seventh check mark. Not every time, but most of the time. And if we don't have money after the seventh check mark, most of the time, something is wrong in those seven parts, and we got to find it. And this adds a very systematic approach to your trading, and it eliminates this vague notion of I've got to buy and sell correctly. And trading is far beyond that. So let us begin. Okay. Um, the first thing I'm going to do is I'm going to map out the seven parts like this: part one, part two, part three, and part four. I did that not so evenly, but we're going to break the seven parts into two um, columns. Then the right column has three parts. Okay, and there are our seven components: 1, 2, 3, 4, 5, 6, and 7. And the way you run through a trade is to start here. Boom. You handle one first, then you move to two, then you move to part three, then you move to four. Now, this part of the list, as you'll see in a little while, these four items or these four components always happen in the same order. You have to do your trade in the same order. You have to handle the first part first, then the second, and the third, then the fourth. The reason why I separate 5, 6, and 7 is because from 4, you might go to 7 next. Or your trade might call for you going to 5 next. And then from 5 to 6. Or you might go from 7 to 5. And then from 5 back to 7. And then from 7 to 6. So here is a little bit more complex because it's not necessarily in order. But I will tell you that the key to solid trading is getting your four parts correct first so that the second parts kind of fall in line. Most of our problems are here. All right. So let's start covering the seven parts. Part one is what I call, I don't know if I should do this bigger. All right. Part one is what I call identify. Identification. That's part one. Okay. This is box one. Now, in box one or next to box one, called identify, this is where every trade starts. You must identify what you are buying or shorting. What is the opportunity? And most traders who are losing traders get the trade wrong at step one. They're not identifying anything. You know why? Because they're playing a feeling. I just feel that this is down far enough and it should go up now. That's not identifying anything. That's a feeling. I think that the market's going to go down from here. That's not identifying anything. That is a thought, an idea. And the vast majority of market participants are trading from a thought or an idea or feeling. They don't have their trading approach defined by specific things to identify. So What are the things that we identify? One, we identify elephants, elephant bars. Now, as you know, elephant bars represent about 60% of all trades. Elephant bar plays represent 60% of all trades. They're solid green bars on your 2-minute chart or any time frame for that matter, and solid red bars, more solid and more lengthy than your average red or green bar before it over the past 10 bars or so. So that's one of the key ways to determine whether or not your stock is truly forming an elephant bar. Is it the fattest, longest bar over the last 10 bars of the same color? So if it's an elephant green bar, over the last 10 green bars, is this bar more sizable? It's not over the entire history of the stock. It's over the recent history of the stock that it only matters. And 10 is just a general guideline, 10, 12, 15, whatever's. The recent history to the left of your chart. Is this bar not normal? That's the key to identifying an elephant bar. Is this green bar that I see right now, this tall green bar, this solid green bar, is it taller? Is it more solid than the vast majority of the green bars over the last 10, 12 bars? That's the key to identifying elephant bars. 60% of your plays, 60% of all plays are elephant bars are elephant oriented bars, are based off of elephant bars. Item number 2, tail bars. Now, of course, you have bull elephants and bear elephants. Tail bars. All right? Tail bars will represent about 15% or so of your plays. So look at where you are with elephants and tails. You're at 75% of all trades. Now, as you know, tail bars are 3 different types. You can have a tail bar with a bottoming tail bar with a green bar at the top, a bottoming tail bar with a red bar at the top, or you can have a bottoming tail bar with no color. It's all primarily the same. The importance of a tail bar is the tail itself, not really the body. And by definition, a tail bar has a little body, whether it's red, green, or no color. The body is small. I am tired of traders calling this a tail bar. Stop it, please. Tail bars have little bodies. They're almost all tails. That's why we call them a tail bar. This is not a tail bar, traders. All right? A tail bar is like an eel-looking animal in the sea. It has a little head, but it is mostly tail. So think of an eel. When you think of a tail, the head is the smallest part of the eel. Tell me you understand this. Just a few of you let me know. The real classic tails have little heads, and they're mostly body. That body is in the form of a tail, like an eel. Okay? If it's not an eel-like thing, formation, then it's really not a tail. You're not really playing a quality tail. Okay. Now, tails are significant. Why? Because I can draw this over again. Tails are not significant, very significant because they are turning the other side completely around, right? So a bottoming tail bar is first down and then up. It's turning the red around, leaving behind a tail in its wake. Okay. So a tail bar is really what we're going to cover next, is really a hidden 180. All right. That's what a tail really is. So we've got in our identification category, all right, in our identification category, identify, we've got one elephant bar. Now remember, these can be bull elephant, green, red elephant, bear. This is 60% of all trades. Two, pure tail bars, not the ones that some of you call tail bars. Pure tail bars, let's do it like that. Tail bars, they represent 15% of all trades, the pure ones. Okay? Three are 180s. These represent 10%, maybe a little less, but we're rounding. Okay? You know what? I'm going to make this is closer to 5% if you really want to be strict with it. It's between 5 and 10. Let's just leave it. It doesn't matter. These are all just general guidelines. All right. Now, the bull 180 is really a delayed tail bar. Remember I told you that a tail bar, a bottoming tail bar, for instance, goes down first, and then later in the same bar kind of reverses most of the down or all of the down to create a bottoming tail bar. So it has removed a lot of red to become a tail bar. Well, the bull 180 is just that same event down, but the erasing of the red comes later, the next bar. Boom. So these events are very similar. It's just that the erasing of red happens inside of the same bar. The erasing of red here happens the next bar. So in a sense, the bull 180 is a delayed bottoming tail bar. That if you put this green on top of this red, it would look like this bar. Conversely, if you separated the green away from this bar, it would look like a bull 180. Similar events. Similar events. I will tell you one very interesting statistical fact. In most cases, not all, nothing is all cases, but in most cases, whatever is delayed tends to be a bit more powerful. So if I had to rate, right? If I had to rate um, tail bars, tail bar, and 180, if I had to rate them on on a power scale of 1 to 10, I would give a tail bar a 5, and I would give a 180 an 8. You see? So the 180 is more powerful than a tail bar. Why? Because the reversal is a little bit delayed. And that delayed aspect of reversing the red, that delayed aspect is what makes it a little bit more powerful. Okay? So whatever happens right away is a little less powerful than whatever happens a little bit later. Now, let me demonstrate this in another concept, and you'll understand this very clearly. So check this out. Stock drops hard. In most cases, when we are in a normal market environment, what is this bounce called? What is that? What do I call that? That's a dead cat bounce, right? All right. So your cat was up here. I'm an animal lover, guys. So this is just your cat's here, falls, gets dropped off the building. At the point of contact, this cat, unfortunately, is dead, right? At the point of contact. The body of the cat might bounce, but that does not mean that that body is dead. That body is alive. That cat's alive. The cat died at the point of contact. So you see the body of the cat, but the spirit's gone. And what normally should happen after a violent drop like that is that, right? Now, if we take the same concept, boom, cat's dead. And now this starts to move up. It's not the same. You see, the dead cat here was given time to heal or come back to life. The damaged cat here has time away from the trouble or accident. And so this move up is a delayed move up. This move up is not delayed. This one has more merit. This one has less merit. Do you understand that? Okay, you got that concept, right? So a delayed move up after a drop down has greater odds of being true and real than an immediate move up after a very powerful move down. The cat here hasn't had time to mend, to heal. The cat here has gone through some recuperation. Okay? Now, this brings us back to something else that's interesting. Let's take that same scenario. Boom! Cat hits the pavement here. Cat starts here, right? Bounce. The body of the cat is bouncing and bouncing. Now, what normally happens is that bounce usually peters out if this is really violent because that cat's dead. Just the carcass is bouncing. But if this thing keeps bouncing and bouncing, then the cat is not dead. And whoever threw the cat off the roof had better run because this is an angry cat. And what is this pattern called? Bull 180. The Bull 180 is an angry cat who should have been dead but is not, and is coming back for vengeance. Okay? And a very vengeful cat. I don't know if you have cats. You don't want them to get angry. Trust me. So there's the power of your Bull 180. It's an exception to what should happen, which is also where its power is. Okay? All right. So we're still working off identifying. We have the elephant bar, which is 60%. We have the tail bar, which is 15%. We have the very powerful 180 scenario, which is 10%. And then we have the RBI and GBI for the short side, right? All of you should know what that means. All right. That's a scenario where you've got an up bar, a pause bar, and you're back to boom, another up bar. This little pause right there is a very important key. The reason why this becomes your buy point. Now, the reason why the RBI is such a beautiful concept after strength. You need strength to the left. So the key to this play is strength is to the left, and then the pause happens. And then the pause gives way to another bout of strength. Okay? The reason why this is significant is that I want you to think of the start, if you will, of a football match, a sporting event. It could be basketball, it could be football, you know, American football, it could be soccer, whatever. You see, in the first move up, this is the beginning of the game, and one team has had the ball. They won the coin flip or the tip off, and they've done well. Boom! They've scored. So the first team to get the ball does well and scores. Great. Their fans are screaming, yeah, 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 yeah. But we haven't seen the other team yet get the ball. We don't know yet. All right, this team scored. Now the other team's going to get the ball. What if they show themselves to be more dominant than the team that just scored? So now they get their chance. They get the ball. And what do they do with it? That's it. They produce A little this, they pass the ball once or twice and boom, lose control of the ball again almost immediately. The other team gets the ball very quickly again and boom. So now when you're judging blue team versus red team, both have had a chance with the ball. Who's clearly dominant? The blue team in my drawing. That you've seen both teams have the ball. And out of those two times, out of those periods of the blue team getting the ball and the red team getting the ball, it is clear that the red team is weaker and in less control of the ball than the blue team. We bet with the blue team. You see, before this red bar, we don't have an opportunity to see if the red team is more powerful than the blue team because they never got the ball yet. And that's the key to the RBI. That red bar is telling you, that little red bar is telling you that when the sellers get their turn, they can't do anything significant. The blue team won't allow them. And so the very next time blue takes out red, boom, we're in. Now, we're in above the red and our stop is under the red if that is our first play. This event is a very key event for a variety of things. Number one, it's the go-to event when you are having trouble in your trading and you're losing too much. When you're losing too much, you revert to RBI and GBI trading and you eliminate these because these are all big bar movements. This is a little bar movement. Most of the time, if you're losing too much, you're losing on the big bar movements. And so for a while, you drop the big bar movements and get your rhythm back by going to the small bar movements, which have smaller risk. Now, what's interesting about the small bar movements is that there is a higher degree of accuracy and consistency with the small bar movements. How's that? That's right. RBIs and GBIs actually are more consistent than anything. More consistent than elephant bars, more consistent than tail bars, more consistent than 180s. So think about this. The RBI and GBI has the smallest risk of the four and has the highest accuracy. I'm going to repeat that. The RBI and GBI has the smallest risk of all four and has the highest consistency of all four. So whenever I explain this to traders, they say, well, Oliver, wait a minute. If number 4 is better on risk and better on consistency, why am I bothered with 1, 2, and 3 again? Can I just make my living off RBIs and GBIs? Well, yes. But you will be leaving behind some of the most explosive gains of your entire life. The most explosive gains come from this. Consistency, yes. Winning trades, oh yes, absolutely. Explosive is more 1, 2, 3. The oh my God moves are 1, 2, 3. Do you understand? RBIs, GBIs aren't oh my God moves. They're consistent. But you want to try to master them both. You want to try to master where your oh my God moves are going to happen from, as well as the consistency of the RBI and GBI. That's the best of both worlds. But whenever you're having trouble, I want you to become an RBI, GBI trader. If you're getting beat up, I want you to become an RBI, GBI trader for a few days. If you've been knocked around and disoriented, if you're depressed, I don't know what to do, my God, I'm getting killed out here. I want you to become an RBI, GBI trader for a few days. Tell me you understand this. It will get you back. All right? It will get you back. I just realized there's no way we're going to cover this whole list in one day because I want to delve into all of the nuances here, which I think is better. So I'm going to do this again because repetition has a value here. Elephant bar, 60% of all trades. 2, tail. 10%. 3, 180. It's closer to between 5 and this is 15%, sorry. Closer between 5 and 10, more in the middle, like 7%, whatever, but let's just round it to 10. And then 4, RBI, GBI, we're going to put that, right? We're going to put that at 10%. And where are we? So we're at 75 with the elephant bar and tail bar, 85 and 95 with these 4 items. I'm going to throw this in there for you to round out the 100%. Narrow range bar plays. Now, what do I mean by narrow range bar plays? Isn't RBI a narrow range bar play? Yes, it falls into that category. But this, I want to give narrow range bar a special category because it's a broader category than RBI. It doesn't have to be an RBI. So let me give you an example of what a narrow range bar would be. Here's a rally, and then you get a pullback. That's a narrow range bar. Let's say that narrow range bar is right by the 20. Now, it doesn't matter what color that bar is. That little bar can be green, it can be red, it can be a cross like this. So it can look like this. Let me show you. That little bar right there can look like this. That little bar can look like this. That little bar can look like this, just like your tail, or this, or this. It's not the color or lack thereof, it's the fact that from high to low, it's little. Any color, as long as high to low, it's little. High to low. That's a little bar. Now, a little bar off of a specific location can be powerful. All right? That's what a narrow range bar play is. Betting, hold your horses. We're going to get there. All right. So you want to be able to identify little tiny bars. All right. Now, I need you to understand these percentages. I need you to understand these five things. These are the only things that you need to identify. Guys, I've done the work for you over 3 decades. I've done the investigation. I've done the study. I've done the testing. I've lost all the money for you in discovering out of all the events that happen in the market, which have the highest importance. It's in your face right here. In your face right here. You don't have to test this. You don't have to tinker with other things. This is it. I have discovered and distilled down to these five things. Most of your gains are going to come from these five things. So your job is to put together a list of stocks, no more than 10, no less than 6. Okay? Listen to me. No more than 10, no less than 6. Out of the 6 or 10, you're going to have 3 go-tos. 3 are going to be your go-to. It's sort of like having a family and then having 3 favorites, right? So whether it's 6 or 10, you're going to have 3 go-tos. Now, you'll play all 10, but your go-tos are going to get the most attention from you. Now, your job with these 10 stocks, and especially your 3 go-tos, your 6 to 10, or especially your 3 go-tos, is to basically, traders, sit and wait. This starts the first step toward proper trading. You're a waiter. You're not a discoverer of anything. You're not a searcher. You're a waiter. You wait. You wait for one of these 5 things to happen. And it should not matter which one happens first. You might get an elephant bar that happens first. Okay, then elephant bar it is. You might get a tail bar. Okay, then tail bar it is. It's not your job to choose. It's your job to wait. And so think of it this way. Your stock is Apple. The market opens. Your job is not to figure out whether to buy or sell. That is not your job. Your job is to wait for which one of these 5 things steps up and calls your name first. If it is a bull elephant bar, of course, in the right position, we'll get to that, then your choice is made for you, your buyer. If it is a topping tail bar in a sell location, then it is not for you to decide. Your play has been decided for you. Your fate is in the hands of whatever presents itself to you. And when you start to approach trading this way, that it is not your decision, you're moving in the right direction. The problem starts when the ego says, no, I decide. I figure it out. I make a decision. When in fact, that's not true. There are no decisions made by the trader. Well, there's a few, but not many. We'll get to those. Most decisions are made by the market if you're playing the market properly. This is why you don't have to know anything in advance. Okay? If it's a bear elephant bar in the right location, it's a sell. If it's a bottoming tail bar in the right location, it's a buy. You have nothing to do with that. If it's a narrow range bar at a rising 20-period moving average, it's a buy. You have nothing to do with that. Tell me you understand this. Your decisions are made for you. You're just a follower. You're just a waiter. You're not the important part of the equation. These five things are. Again, the problem comes when you're trying to figure something out. There's nothing to figure out. There's just sitting and waiting. And here's another thing, guys. You should not be choosing. You should not be choosing, oh, wait a minute, there's a tail bar, but I don't like tail bars. I'm going to wait for something else. No. Your destiny is laid out by what comes first. When I sit down at my trading desk a couple minutes before they open and then boom, the market opens, I don't know what the first bar is going to be. I'm not trying to figure out what the first bar is going to be. I'm watching what the first bar is doing. And if the first bar forms into a bear elephant bar, boom, short. If the first bar forms into a bottoming tail bar and it's the right location, boom. If the first bar gives me nothing, but the second bar gives me a bull 180, boom. If there's nothing on the first bar, nothing on the second bar, and what happens next is an RBI, boom. You understand? I don't decide anything. I play what happens. If what happens is one of these five things. My destiny is already laid out for me. And this makes trading less stressful. This makes trading pretty easy in comparison to the mindset that thinks it's got to figure something out. I'm always joking. Somebody says, Oliver, I've been getting this question very frequently as of late. Do you think Apple's going to go down more? I'm like, well, can I tell you after I see if it goes down more? Or do you want me to tell you before that? Like, I don't know. But I can certainly tell you tomorrow, once the market opens, whether it is going to go, whether it's gone down more or not. But I don't have to know. I just have to wait. All right. All of these things have a relatively high follow-through rate, guys. That's why they're your five things. Elephant bars have a very high consistency rate to follow through, a fairly high consistency rate to follow through. Tail bars, 180s. The follow-through factor is very, very good in all of these. That is why they have made the list. Okay? So just by playing these five things, you're already got the edge in your favor because of the follow-through factor. Bull elephant bars follow through in the same direction a good percentage of the time. Bottoming tail bars follow through in the same direction a good percentage of the time. 180s, RBIs, narrow range bars off of a key location. Yes. All right. So this is box number one. Now let me show you how you put this box together. You have on your sheet of paper something like this. You can do it any way you want to. It doesn't have to be in the form of a box either, but I'm going to put the identification box. Now, you go something like this. Now, let me do it bigger, just so I have space, right? So this is your identification box, right? And you've got elephant bar, space. Okay? You've got tail bar and a line. That's where you're going to put your check mark. This is a blank piece of paper with these things already laid out on it. You have a 180 and a line next to it. You have RBI and of course the GBI in reverse and a line next to it. You have narrow range bar and a line next to it. Now this is the first box on your sheet of paper. And let's say it's Apple. Let's say you've got the date here at the top somewhere. You got the symbol. All right. And later you can fill out whether it's a long or short. You can put all kinds of information at the top. What time frame, 2 minute, whatever. And later you can put whether it was a win or loss. All right. That's all at the top. Today's date, the 9th. Symbols Apple. This was the first thing that came to me in Apple this morning was an elephant bar. Boom, check. That makes it a long. And at the end of the list, you'll put in whether it was a win or not and the dollar amount of the win or not. All right. So it just becomes a check. In Apple this morning, what comes first? What happens first? Which one of these things happens first? Boom, elephant bar, check. Now I've got one of the 7 things done. The next thing you're going to go to is, well, I got this, an elephant bar occurred in Apple. What's the position or location of that elephant bar? Now we go into positions. There are 7 positions. 7 positions. And now we delve into the positions. Because if you identify the right thing, and that right thing is in a powerful position, my God, you just stacked the odds. You double the odds in your favor. You got good odds no matter what the position is with these 5 things. But you increase the odds if these 5 things are also in a preferred position. And so box number 2 or step number 2 in your process is a purifier. Right? I've got my elephant bar, but is it one of the better elephant bars based on position? It's a purifier. Which elephant bars are the creme de la creme? Our elephant bars are creme. Those are special. But what's the special elephant bars? Well, position's going to tell you that. Do you understand what I mean by a purifier? It takes all the elephant bars and narrows them down to the better ones. It's a purifier. All right. All of the tail bars, it's a purifier of the tail bars. It's a purifier of your bull 180s. It's a purifier of everything. Okay, so step number 2 is a purifier. Now, you might want to take a picture of this because I'm going to erase everything and just focus on position now. All right, guys, give me a minute. I got to do a very quick bathroom break, so you're not going to hear any sound. As a matter of fact, you know what I'll do? I'll play music until I get back. I'll be right back. Take a picture of this, put your thoughts down or whatever. I'll be right back, and we'll start with position. All right, guys, I'm back. Position. There are 7 positions. All right. Now, the best way to cover positions is going to be based on, let's call this the Fab Four. I'll cover that in a minute. But this is the Fabulous Four zone. Okay. I'll cover that in a minute. There's a zone, there's an area above the Fabulous Four, and there's an area below the Fabulous Four. We have 3 positions above and 3 positions below, which make up 6. So above the Fabulous Four zone, there is position. There is the plus position. You are above this zone. Then there is the plus. These words are getting in my way. Plus, there is plus, plus, and then there's so far away that you are plus, plus, plus. So plus, 1 plus is just above the Fabulous Four zone. Plus, plus is you're not close, but you're not super far away either. So you can't consider it close, but you can't consider it excessive either. That's plus, plus. Plus, plus, plus is excessive. This is excessively far from the Fabulous Four zone. Some of you got this. Plus, close, plus, plus, not close, but not excessive, plus, 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 excessive. Got it? All right. Now, of course, above, so let's do this now. In your plus category, it's all buying. The up arrows mean buy. This position is never a short position. Never. It's only buying. Now let's go to this position. Buying, buying, and you can at times take a short from that position. At times. But as you can see by the 2 arrows to the up and 1 arrow to the down, you should be buying more often than shorting from this position. You should only be buying from the first position, never shorting. There are times when you get something so powerful in the plus plus position that you can take it short. Like it's not super high, but it's, my God, look at the power of this elephant bar there. Bear elephant bar. I got to go short there. Boom. Okay. Look at this. From the excessive, Can you go buy? Absolutely. But you want to be short up here more than you're buying. It's just that you might still get something so powerful that you got to take the buy anyway. So this is a neat little way of making sure that most of your actions are falling in most of your you are statistically putting the odds in your favor by being more focused on short and in the excessive positional way, being exclusively focused on long in plus territory, being mostly long in plus plus territory, occasionally short, and mostly short in excessive territory, occasionally long. Do you understand this concept so far? All right. Okay. To give you an example of this, let me go to Apple this morning. Well, that's not a great example, is it? It is not a great example. Let's see. Okay, Baba. Now, I wouldn't say Baba is right above the Fat Four. I wouldn't say it's excessively above at the open either. All right. Um, so here's a topping tail bar. So remember on my identification box, I do topping tail bar. I check, boom, check topping tail bar. Position, okay, plus, plus, check, okay. Can I take a short from plus, plus? Yeah, okay. It's not the absolute best location, but it's allowed. Boom. Stop. You see how this works? You see how this works? Okay. Now, what if it was this? What if it was this? Uh, Topping tail bar. Check. That's my identification. Position. Plus. Can I take the short? No. All right. Now you see how the checklist decides for you. You're starting to see how the checklist decides for you. All right. So the person saying, wow, look at this. So the person saying, wow, look, bear elephant bar. Okay. Identify. Bear elephant bar. So I do minus for that. Bear elephant bar. Check. Okay. Position. Plus. Check. Can I go short this? No. See? All right. Now you're starting to see how the list is going to help you lead yourself to the highest odds actions. No, this is low odds. Doesn't pass the purification test on position. Yes, this does match. It's not the greatest location like this. Okay, so look, identification, tail, topping, tail bar, topping tail bar. Okay, position. Okay, plus, plus, check. All right. Can I go short here? Yes. Is it the best location to go short? No. So now you can start bringing into, since it's not the best location, this is a normal play. The best location is a little bit more than normal. So, all right, best location, I do 3 lots. Normal location, I do 2 lots. Not so great location, I do 1 lot. Now, what would a not so great location be? Plus, plus, plus long. 1 lot. It's allowed, but you've got the least allowed scenario. Now you can bring in size. You can bring in size analysis with how pure is the play based on position. All right. Good stuff. Good stuff. Let's go. Bull elephant bar. Check. Position. Let's do it like this, right? Sorry. Bull identification. Bull elephant bar. Check. Position. Plus. Check. Can I buy it? Can I buy it? Yes. Can I buy 3 lots? Let's say. If I want to. Yes. And that's exactly what I did. This is one of my plays. Okay. So, guys, let's finish up the positions. Now, if we take what we've covered so far, let's just go below. You've got the same thing below the Fat 4. You've got -1. That's just below the Fat 4. You've got -2. That's not close, but not excessive either. And then you've got excessive. Okay. Okay, now you're only considering short here, never a long. You're mostly considering short here, but is it possible if you get something powerful here to go long? Of course. Oh, wait a minute. I'm doing that with the wrong pen. Sorry about that, guys. It's the wrong pen. Um, sorry. -1, just under the Fab Four. -2, not close, but not excessive. And then excessive. Ah, okay. Now, from -1, you almost never want to go long. Only shorts there. From -2, you want to mostly be thinking short, but can you take a long if something really powerful on the long side happens there? Of course. And from excessive, mostly long, but every now and then if something's really powerful, you can still go short. But you should not be going short from excessive more often than going long. Position guiding. This is your position guide. Now, the seventh position is trap zone. That's when your stock opens in the middle of the Fab 4 zone. It's not above it, it's not below it. It's dead smack in the middle of it. It's trapped. The Fabulous 4 is sort of like a box. Your stock is inside the box. It's not outside of the box. It's not outside of the cage. And I prefer that you bypass trap zones. All right. You want your stock free. You want it to have open skies above, or you want it to have a free fall ability below it. Open skies above, nothing above it, or free to collapse below it, nothing obstructing its potential to fall below it. In the trap zone, you've got a ceiling above it and a floor beneath it. It's trapped between a ceiling and a floor, a ceiling and a floor. Ping pong, ping pong, ping pong, ping pong. Above it, it's free. Below it, it's free. Inside, it's caged. A few of you let me know if you understand this. Okay, now that you understand that, let us go to identifying the Fab Four. So let's take Microsoft. The way you identify the Fab Four is you grab the four items. There are two moving average items and two price items. Here are the moving average items. We're going to take the 20 and the 200. Item 1 and item 2. We're going to take yesterday's closing price, this dashed line right there. That's item 3. And item 4 is you're going to take yesterday's absolute. You're gonna look at the last 45 minutes to an hour of price data. All right. So that's roughly, let's call that 1,500 hours. Let's call that like here. This is the last hour, right? You're going to grab the highest price in the last hour and the lowest price of the last hour. See? And let's connect them in your mind. And this makes item number 4. This rod, this is like a rod, right? Now, what's out of these 4 items? What's the highest item? Well, item number 2 is the highest, so that's our ceiling. We got to find our ceiling and our floor. Now, of 1, 3, and 4, which is lower? Is 1 lower than 3? No. Is 4 lower than 3? Yes. So this becomes my floor. And I extend my floor into the future, and I extend my ceiling into the future. Now I've got my fabulous 4 zone. If my stock opens in this zone, it's trapped. If it opens outside of the zone above, then the odds would suggest that your better trades are long. If it opens below, the odds would suggest that your better trades are short. Okay? So why would you not want to short here? Well, it's not high odds because you're in position 1 plus 1. Why is it better to say, okay, bottoming tail bar buy, bull elephant bar buy? Because of your position. All right. Okay. Give me a second here. Give me a second here. All right. All right. NVIDIA. Let us grab the 4 items. 20, 200, right off the open. Yesterday's closing price. No. the low, the last low of the last hour, the most recent high of the last hour. So the last low and the last high, we create a rod. Now, obviously, 2 is the ceiling, and the lower part of the rod is the floor. Got my Fat 4 zone. Stock opens above and starts to show weakness, but not interested in weakness. That's not the best location for weakness. But a bull 180, okay. An elephant bar, okay. All right. Okay. I'm good here. These, whatever buy signals you get, you're in plus location. So you're not waiting for sell signals here. Like this is a sell signal. This red bar is a bear 180. But look at the location. It's a bad location for a sell. So you want to ignore sells and only look at buys. 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 So, very quickly, I see this is a buy, stop, buy, stop, buy, stop, buy, stop. And really and more advanced, buy, stop. Does this make sense? Okay, now yesterday I would have been able to show you, well, let's go. Yesterday. Used to, no, that was that's yesterday, but yeah. Okay. So let's grab our fat flow. 20, 200 you can imagine is there. 100. Yesterday's closing price. Last high, last low. Make the rod. Now, where's the top ceiling? Well, the rod is the highest. The top of the rod is the highest. That's my ceiling. And the 200 is the lower of all items, and that's my floor. So here's my fat 4. Topping tail bar. You see that topping tail bar? Boom. Look at the position. Is it beautiful? There you go. Nothing's going to be 100%, but I will tell you that if you get your your beautiful play, a beautiful tail bar, a beautiful elephant bar, a beautiful bull 180, bear 180, whatever it is, and you purify it with the right location, if it's purified with the right location, you really greatly stack the odds in your favor. Okay? Now, see this green bar that shoots up here and takes out this red here. Why is that not a buy or considered a buy, well, you're in negative territory. And I don't care if you want to call this negative or negative. It's not quite that. I would say this is more excessive. And this would be a little bit further down. But that's just not a great location. But if it gets taken out, boom, there's another short. Which one of your items is that? GBI. Check. What's the position? This is identification. This is position. What's the position? Can you do it? Yes. All right. Your stock does this, pause, and this. Okay. All right. Good. I like this. I like this. I I think it's important for me to mention this now. That the Fabulous Four is really a concept that applies to the open. There's your open right there for the most part. After the open, the Fabulous Four loses relevance. Okay? After the open, the Fabulous Four loses relevance. So then, how do you determine position? You determine position by your key moving averages. So yesterday's closing price loses relevance and the prior day's range loses relevance. Now, why do these things lose relevance? Or another question, another way to answer that, why do they have relevance at the open? This has relevance. Whoa, that fell hard. This has relevance at the open because there's no history yet. This doesn't exist yet. So if there's no history at the open, I've got to use history from yesterday. But as the morning wears on, I have my own history today, which means I don't need the history from yesterday anymore. Does this make sense? Once I have my own history today, I don't need yesterday's history. So now it's today's history and the 20 and 200. Less relevant betting. This is what I'm saying. So now it's just this. Okay. Look, Elephant bar. Are you close to the 20? Yes, that's good. Now it's plus from the 20's perspective, not from your original Fab Four's perspective. Now it's the 20. It's the 20. No pre-market, no. All right. It's the 20. You see? It's what's your relevant moving average. It's no longer the original Fab Four to determine position. Now, if you get a stock that has its 20 like this, it's a 20, and the stock is like this, and gives you a topping tail bar, now in relationship to its 20, that's plus, plus, plus. Not the original Fab Four, it's in relationship to the 20 now. So position, the concept of position changes away from the Fab Four after the open to the 20 period moving average largely, and sometimes the 200. You got this? I've got my own history. Now, how do you bring history, today's history, into this concept? Easy. I will show you. Let me try to get a clear, let me get a chart that's got some clear space. Okay, cool. This one. All right. Let me just erase this for a moment. Just want to erase. Just create my own clear space here. All right. I'm going to draw on top of this clear space here. I don't want to eliminate what I have on the whiteboard yet. All right. So let's say you have a stop. Here's your 20 period moving average. You stop. It's doing this, and boom. Elephant bar. Okay. Now here, you are away from the 20. You're high above the 20. So this would be 1. This might be like that. Okay. As far as history and price is concerned, where is your stock in relationship to where the igniting move happens? That is also far. So it's far from your 20 and far from the igniting, the point at which the move began is far. What ignited the event? That ignited the event. Well, it's far from what started it and far from the 20. So that's using price history today. But at the open, we don't have price history from today. So we need these four things. See? We need yesterday's history. Now, we don't need yesterday's history. Now, look at this. Look, here's where this move began. From this history. Right? So the further you get away from the 20, the higher you are in plus territory. And also, the further the 20 gets from the 200, when that's excessive as well, can be excessive. All right. So you want to be careful doing buys. If you get a buy signal here, you're just a bit far. This buy signal is okay because you're in plus territory. Better. If I can give you, let's go to MU. This is a questionable buy because of the Fat 4 right there. But a lot of people would jump into that. It's not the greatest location. This looks like it's a short, but in most cases that doesn't work. It just worked this time because that's a negative sign right above the Fat 4. But sometimes you just miss money. Look, I'm always telling traders, don't, just because someone made $150,000 selling drugs doesn't mean you should have done that. Just because MU made money from the wrong location doesn't mean you should have done it. All the money that potentially can be made is not yours. You're defining what's your money. Drug money is not your money. Trading money is. Stupid money is not your money. Smart money is. Do you understand? So don't waste time showing me stupid money. Don't show me drug money. Yes, but Oliver, look at this one. This one worked. That's drug money. I don't want that. All right. I don't want to make money doing stupid things. I want to make money doing smart things. Buying in this shorting in this location will over time land me dead or in jail. But sometimes people do the stupid things, get away with it for a while. That's all. Okay. Guys, I got a lot of kids that just try to find these ways of drilling in truths to them, making it smack them in the faces. All right. Look at your QCOM this morning. Nice location there. All right. Uh-oh, negative. Don't you dare go short. That's stupid. Location to be thinking short. And I guarantee you there are traders in my team went short there. Even if they made money, it wasn't smart. All right. Even if it's not smart. Telling you. Got some missing data here. I think we went over the okay. Later after the open, it's now the 20 mostly. Okay. All right, that's okay. All right, that's okay. All right, that's okay. You're not that far away. But as this separates, and especially if your stock gets too far away from the 20, you're getting into plus, plus, plus territory. So you want to just be aware of that kind of stuff, you know. Trying to think if I can find something else here. All right. PayPal's an interesting. All right, you want to try that. All right, let's make sure that risk is tight. All right. Drop back, you want to be thinking about covering. You know, it's not exactly there. So, all right, but just do it carefully. You get something really powerful like this, wiping out all this green, just do it carefully. Just make sure you don't do that here. Leave that for the stupid money. Okay, let me just take this. I take these gains quickly, especially when I'm teaching you here. So not necessarily some plays I want you taking either, though. Okay. See, so for me, guys, we're talking time of day, some separation. You're starting to get some bigger red footprints, but still things are bullish. No question. Okay, beautiful. You're not that far, you know? I'm not going to take that RBI. RBI, check. Position, not so sure about that one. So you see how positions your purifier, yes? So still got that filled my baba, filled me, covered me on the baba short. All right. Um, so Betty's asking, thanks, Lily. What happens if you get a lot of topping tails in the bullish location. See, Betty wants to start breaking the rules. See, I knew I was going to get it. I want to break the rules. What about this one? I'm teasing. Um, there are things that can cancel a position out, guys, but can we just stick with these for now? Let's ease our way into what cancels. I'd like to cover the exceptions as we develop. Like, you never start off teaching the law with the exceptions to the law. You want your citizens obeying the law. And so sometimes in court, the judge uses judgment to say, well, you know, technically this is breaking the law, but the law in this case wasn't designed to, in the spirit, apply to this. So I'm going to let it go. Like, that's why you have a judge. Otherwise, the law is black and white. What do you need a judge for? Those exceptions, right? But I need to cover those exceptions through your trades, not when I'm laying down the law. So when we cover your trades, the exceptions are going to come out of that. All right. Okay. But yes, there are exceptions always to everything. Okay. Mm. Let's let. Give me a second here, guys. I love this though. I love it. I love this. Like, guys, I'm 38 years into this, 30, almost 34 years professionally. And every time I go over these things, it helps me. So just imagine how my bringing you back to the basics even helps me. Crazy, right? Uh, Let me do something here, guys. Give me a second here, guys. Hey, what's up? You ready? All right, cool. I'll be. All right, guys. So I'm gonna stop it here, guys, because initially I wanted to at least get through the first four boxes in the first session, but I realized I didn't want to miss a lot of detail and nuances, and I think that's way more important than rushing you through this. So we're gonna stop at the identification box and the position box. Now, tomorrow, I want to make sure we get the entry box and the initial stop box complete. Remember, I told you that these four always happen in the same order. Whoa. These four happen in the same order. And if you work on making sure that you are doing the purest trades based on these four boxes, I promise you, the rest kind of takes care of itself in a way. Or you make the other three boxes a lot easier in terms of what they're supposed to do. They kind of flow out of these three. But most people are wrong right here. And even if they're right here, they're definitely wrong with the position. And you get these two wrong, and just everything else flows from a bad seed. Identifying pure plays in the right position, this flavors a lot of the rest. It flavors how your entry, because if you're entering correctly on the wrong play in the wrong position, who cares what the entry is? Who cares if you're keeping your losses contained with a nice stop on the wrong stupid play? You've got a good stop on a stupid play. What benefit is that? Do you follow what I'm saying? So you can do everything else right. Great entry, great stop, but it's on a stupid play. So these first two are like so important. It flavors the rest of the trade. All right. All right. So tomorrow we come back and we start off with entry. That'll be the most involved. Initial stop, and then the initial stop. And then we'll have that four in place, the first four boxes in place. And then I want you working with those four boxes for a few days. And then next week, we'll cover the other three boxes. And once we get all seven set, you'll have a full, complete checklist to just check your way through all the seven boxes. And then repeat and repeat. Check, 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 check. Seven boxes, done. Repeat, repeat, repeat. And if you're getting the check marks correct, that's all you need to worry about. You don't worry about whether at the end of the seventh box, if this was a win or a loss. That's not the key. Did you get through the seven boxes correctly? And so this is a way that ensures that you're building your experience the right way. You do realize that you can take trades that don't build your experience. You can take trades that retard your experience, that move you backwards. But you can get behind the eight ball, as it were, with the wrong experience, the wrong trades. The wrong trades move you backwards. The right trades move you forward. Even the right trades that lose money move you forward. And that's where we want to be. And how do you know you're doing the trade correctly? How do you know that this losing trade moved you forward? Well, if it's a losing trade, despite the fact that you got all seven boxes correct, that trade moves you forward. But if you lost money because you got everything wrong, that trade moves you backwards. And so that's the value of the list. All right, traders. Enjoy the rest of your trading day. I will see you tomorrow, 45 minutes or so after the open. All right? Ciao for now.